Imagine a world where your retirement savings could include not just stocks and bonds, but also cryptocurrencies and stakes in private companies like OpenAI or SpaceX. This sounds exciting, right? But here's where it gets controversial. The recent executive order from the Trump administration to allow such alternative investments in 401k plans comes with its own set of risks and complexities that many investors might not fully grasp. Christopher Bailey, Director of Retirement at Cerulli Associates, a leading asset management research firm, warns that these investments are uncharted territory. None of this has been stress-tested in a market shock or long-term downturn, he points out. This means that while the potential for higher returns exists, so do significant risks, including liquidity issues and increased fees. Proponents argue that private equity, crypto, and investments in privately held companies offer the promise of greater returns. However, critics contend that these investments are inherently riskier, lack transparency, and come with higher fees compared to traditional retirement plans. Philitza Hansen, head of product, equity, and fund administration at Allview Systems, emphasizes, people aren't discussing the potential for higher fees enough. She adds that the executive order raises more questions than answers, requiring careful consideration of how these assets can be integrated into 401k plans. Traditionally, private equity and other alternative asset funds have attracted capital from wealthy individuals and institutional investors due to their high fees. For example, private equity often follows a 2 and 20 fee structure, where managers receive a 2% annual management fee plus 20% of any profits. In contrast, mutual funds, which dominate 401k plans, typically charge an average of just 0.26% in fees. According to the Investment Company Institute, Dmitry Katznelson, Deputy Chief Investment Officer at WealthSpire Advisors, which manages over $30 billion for high net worth individuals, observes that the executive order could reverse the trend of reducing fees and minimizing harm to investors. He notes that it will take time to develop a framework that balances the benefits of alternative investments with their inherent risks. For alternative asset managers to attract the trillions of dollars and 90 million investors in employer/sponsored retirement plans, they'll need to create products with lower fees, greater liquidity, and more transparency. Jason Kephart, an analyst at Morningstar, highlights that some alternative investments have unclear fee structures, sometimes buried in footnotes, making it difficult for investors to understand the true costs. Investors in traditional 401k plans can monitor daily fluctuations and understand the factors driving their portfolio's performance. However, investments in private equity and assets lack this transparency. Hansen explains, private equity and private assets are the opposite. They require systems designed for daily trades to support illiquid and manually priced assets, creating a fundamental mismatch. This shift necessitates increased education and outreach efforts from asset managers and plan sponsors. A typical retirement fund investor doesn't actively optimize their portfolio or consider the impact of adding private assets on risk and potential returns. As Blackstone president and COO John Gray put it, private assets are better suited for younger investors with longer investment horizons. One real-world example of the legal risks involved in including private investments in retirement plans is the Intel case. Employees sued over retirement plans that included hedge funds, private equity, and commodities. After 7 years of legal battles, the appeals court dismissed the complaint, but the legal costs were substantial. Debevoise Plimpton's lawyers argue that asset managers and plan sponsors lack the resources to manage such prolonged litigation. Regulators will need to provide legal protections to make the Trump administration's vision a reality. In conclusion, while the inclusion of alternative investments in 401k plans presents exciting opportunities for higher returns, it also introduces significant challenges and risks. As we navigate this new landscape, it's crucial to prioritize transparency, education, and risk management to ensure that investors make informed decisions.